Hi there, this is Scott Murray, and welcome to the Daily Economic Market Shout for Monday, November 14th, 2022. It's great having you with me here today. We're going to talk about the Fed. Yes, we got word today, the vice chair of the Fed commenting about the need to slow down the rate increases. Market has moved back. It has moved back to 50 basis points versus 3/4 of the basis points that we had previously seen in the latest Fed meeting that was in November. What does this mean? It means that because of inflation and really because of the concern over the liquidity and the structure of the financial markets, the Fed feels it's probably gone maybe a little bit too far. And so the slowdown and then possibly the removal of the rate hike cycle signals that we are near the end of this tightening. What does that mean? Yes, we've created an inversion. The Fed funds is now above the 10-year rate. That is traditional for an economic slowdown. We do think one will likely come within 6 to 9 months of that signal being officially given. We do like to see it about 3 months of the inversion to make it official. Still, at the end of the day, we think it's going to be a modest slowdown. Where are we today? Today, the Atlanta Fed, which does the GDP now reading, is saying 4% growth. Probably not that fast when we finish all the numbers and we release them at the end of January. But what is it going to say about the economy? It's probably still growing. And the recession is coming, but a little further than people think. However, when it comes, it's probably not going to be too severe. Therefore, we think the market will move ahead quickly beyond it, what we saw in the March of 2020. So yes, this is part of the process of slowing down. But also note, employment is good and the stimulus. In the fiscal year of 2021, we saw the federal budget have a surplus of spending of 1.4 trillion. That means student loans, other programs, that money was put into the economy and that will create economic growth. So even though, the Fed is working to slow down the economy, the federal government is moving in the opposite direction. And that tells us to probably be a little further, from today to have that economic slowdown. Once it comes, it will not be so severe. So what does this say? Yes, it says that the normal business cycle is still in vogue. We have periods where we have growth, and then we kind of meander, and we're seeing that right now. But the good news here is that inventory of houses for sale are not that strong. So people aren't desperate to sell. They'll sell if they want to, but they might pull it off the market. So there's really not that need out there. Further, inventory levels are still very lean. We've gone through 2.5 years of supply chain deliveries getting longer, not shorter. And so that means that inventory levels, while modestly high, given the level of sales we are doing in the economy versus before the pandemic, but it's not severe. And so that inventory reduction that has to occur in a recession could be quick. That resizing, refirming, and creative destruction that we generally see in downturns will occur. It'll be modest, and then we will point ourselves back into economic growth. So yeah, we're getting close to the end of the tightening cycle. The Fed is recognizing the impact on the financial markets that are also hurting the economy. And as they look ahead, they don't want to push the brake too hard because we're already seeing some early signs of inflation dropping. So that is constructive for the economy. So looking ahead, yes, it'll be a challenge for the next 6 months or so. After that, we think there will be brighter skies ahead. This is Scott Murray for the Economic Market Shout daily version. Thanks for joining me.